If you feel like you've hit a ceiling at your mortgage company, or maybe you feel like you're not appreciated for the value that you provide, if that feels like where you're at right now, you're not alone. I talk to loan officers every week, and many of you are frustrated, but you don't know where to go and what move to make next. And you really don't want to make multiple moves because transitions are hard. Thinking about switching mortgage companies, but can't shake the feeling that you're not getting the full story when you talk to people, and you're not alone. So let's break down why top loan officers really move, what they actually earn, and how to spot the difference between real opportunity and a recruiter who's just pretty much has smoke and mirrors. Here's the truth. Most experienced loan officers are skeptical, and you should be. Too many companies promise the world, but only for you to find out that the 90% split is really 60% after hidden fees, or the leads are recycled, or the support is just a generic flyer. So if you're worried about being misled, that's not paranoia. It's wisdom earned in the trenches in this industry, because it can be hard. Trust me, I've been there, and it is why I created this channel and the companies that I now run that support loan officers and mortgage broker owners. I've guided hundreds of loan officers through company changes, and I've seen every trick in the book. The ones who thrive, they ask tough questions, they demand transparency, and they refuse to settle for vague promises. And I'll show you some of the questions to ask so that you don't get burned. What recruiters say versus what it really means is an important thing to think about when you're hearing things. If recruiters are promising you and saying you're going to get 70, 80% after compliance admin fees, that there's tons of leads, that training, that you have marketing materials, marketing support, they're going to connect you with the producer that produces $500,000. What honest companies say is different. They show you. They don't just tell you. They introduce you. They show you the average splits. They break down leads. They show you what they look like. They offer references. So make sure that you can pick apart the difference between what's real and what's hype. Here are 5 questions that expose the truth or help you get to the bottom of who's being truthful and who's not. And the first one is, can you show me the average monthly income for loan officers hired in the last year? Like, I want to see a commission. You can block off the name by experience level. I want to see a beginner. I want to see, someone in the middle, high end. Honest companies have real numbers. And if they dodge that, that's a red flag. The second one is, what's the total breakdown of all fees, processing, tech? Do I need to get an E&O policy? My LOS, how much are credit reports? I want to see a bill. Do you have a commission breakdown that we could walk through once again? Watch for hidden costs that quietly shrink your split. Then make sure to ask about expenses that you don't see on there that you know that you're using right now or have. So if you don't see it on there, but you are using it or have it, ask about it. Number 3, can I speak to 2, 3 loan officers who've joined in the last year, including one who isn't a top producer and somebody who is? If they offer their superstar only or make excuses, be wary. You want to hear people at all levels. Number 4, could you invite me into one of your meetings or your trainings? I want to see the material that you have, that you talk about. See and hear. You want to experience it. Number 5, think of about 2 to 3 scenarios when you had a hard time with a loan, with a situation where you currently work, and or maybe you were asked to reduce commission, and go through that scenario with them and ask them to show you how something similar has been handled or would be handled at their company, and make sure they then put it in writing. So those are 5 great ways to start evaluating the honesty of the person you're talking to. Here's some real stories of loan officers that I've spoken to just in the last few months. The good, the bad, the ugly. Names have been changed to protect people's identities, obviously. So there's Sarah, 5 years at a company, promised an 85% split. They actually get 55% after fees. She gets 70% commissions, but then every file, another $1,600 is taken off for processing and back office operations. Then there was Mike, who joined a brokerage. He was in retail, but the brokerage he now works at only has 5 wholesale lenders, so he doesn't have the access that most broker owners do. Jennifer was another one. that got a $200,000 sign on bonus, can't leave for 3 years, but now she's losing about $100,000 a year because of the poor service and the products where she works. Bottom line, it's not just about the split, the commissions they're going to give you. You have to really dig into all the other stuff. So there's a few ways I say you can spot red flags versus like green lights if you feel good about things. Red flags would be things like pressure to sign quickly. There's a reason that you need to come quickly or come on quickly. They dodge on references. They don't go through actual fee details. Over promises on income or leads than when you talk to loan officers. Maybe they badmouth your current company. That's just not professional. Green lights would be things like they're very transparent. They go through, show you costs, the different things you could pay for. They're willing to provide multiple references or invite you into things their company does. They set realistic timelines, and they make you part of their experience before you even join. And last but not least, they're willing to put things in writing. So if you are going to start thinking about switching over somewhere, here's a few strategies just to keep in mind. Number one, get every promise in writing. Splits, fees, support, leads. 2, talk to multiple people in the company, not just one, and not just a top producer. Negotiate a 90-day trial or an exit clause if things don't go well after 90 days. Keep your network warm and don't burn bridges. Don't sell your new company until you're comfortable. And remember, your reputation is your most valuable asset when you do this. And one of my favorites is plan your divorce before you get married. So think about if things do go bad, how do you want it to play out? And make sure that's part of the contract. So if you're ready to make a move, if you want to vet an offer that you want to have a second set of eyes on somebody's promises to you, I help loan officers spot the real deal from the hype. You can click on the link below. It's free, no BS consultation. Drop your biggest red flag in the comments below. I'm guessing there will be many as this posts, but don't let vague promises cost you income or reputation. Subscribe to the channel for more honest mortgage business insights, and check out my video on all different ways that you can succeed in the mortgage industry. I'll see you guys next time.